Welcome to Illuminati Silver. We tell you the truth about silver. Today is Thursday the 4th of March 2021 and we're looking at silver collapsing below key support levels. So let's take a look. Now yesterday we produced a video entitled Gold hits 8-month low as equities fall too, where we pointed out that gold had fallen as low as $1,702 but recovered slightly to $1,715 but was still down some $20 on the day. And silver, despite falling into the late $25, in fact down to $25.85, recovered most of its losses and stood at $26.77 on Tuesday, then fell back to $25.85.86 yesterday and bounced back to $26.17, down some 60 cents, and that we feared that it would retest this level yet again in the next day or so, i.e. today, especially if the US dollar strengthened further. Now we've placed a link to this video below. Well, at the time of writing, today, which is quite late in the UK, it's 21:55 GMT, gold stands at 16.99, so it's now gone below 1700 and has been as low as 16.91, and silver has plummeted as to 25.37, having been as low as 25.11. Now we think very, very short term it may attempt a moderate recovery, but if the dollar strengthens further, then this recovery will not hold for long. You see, yesterday the dollar index stood at 90.96. Today it strengthened to 91.60. And equities in the US are down between 1 and 2%, with the Nasdaq hardest hit again. Also, for interest, at the time of producing yesterday's video, Bitcoin stood at $51,565, having been above $52,000 earlier that day, and currently it's now resting at $49,100. This is what we said or concluded yesterday. Our suspicion, unless there is further dollar weakness, is that gold will continue to be under pressure for the next day or so. This has happened and may continue again tomorrow. Well, we have seen today that the initial jobless claims have risen again this week, from 736,000 last week to 745 this week, though the continuing jobless claims had fallen from 4.42 million to 4.30 million. The all-important non-farm payrolls due out tomorrow may very well reinforce a disappointing week for employment data, with the ADP figures on Wednesday really not impressing at all. Or will they? Will they buck the trend? That's what we shall be looking at, particularly tomorrow. Now, technically, gold resistance is seen around 1758, compared with yesterday's 1765. Target support is still seen near the June lows of 1670, and the MACD is pointing still to lower prices. However, a higher dollar index and rising treasury yields are certainly placing precious metal prices in check, at least for now. What seems to have spooked the markets today, and especially the Nasdaq, falling again so that it's now reached 10% lower than its February high, have been comments from the Federal Reserve Chair Jerome Powell disappointing investors worried about rising longer-term US bond yields. You see, the benchmark 10-year Treasury yield spiked to 1.533% after Powell's comments today, which did not point to changes in the Fed's asset purchases to tackle the recent jump in yields. Many investors thought that he would increase that, thereby bringing the yield price down. It still held, though, below last week's one-year high of 1.614. But some are fearing that may be reached again. Now, some, as mentioned, investors had expected the Fed would step up purchases of long-term bonds, helping to push down long-term interest rates. But so far this hasn't happened. Now, Scott Brown, the chief economist at Raymond James in Florida, told Reuters, quote, "The market has been worried about the rise in long-term interest rates, and the Fed chair in his commentary didn't really push back towards this increase in rates, and the market took it as a signal that yields could rise further, which is what has happened," unquote. Well, gold fell as a result almost now to a 9-month low, not an 8-month, but a 9-month low, and is testing its first support level below 1700, which is at 1689. Now, the technicals, apart from the MACD, are suggesting that gold is slightly oversold already, and we shall have to see how that responds. Meanwhile, the dollar's rise is at its highest since December 2020, so we can see these various forces having this effect on precious metal prices. Now, we're still, quite frankly, of the opinion that gold may have further to fall, as we're witnessing money still leaving the ETF space. Quite frankly, that area which caused gold's significant rise, and arguably silver's, in the first place. This is why we've been cautious short term. And now we really have to see a number of ETF liquidations to occur before gold can resume its upward trajectory again. Because people have come in at that higher level, they're seeing the gold price fall, they're beginning to panic, and therefore start liquidating their ETF holdings. Now, this view can be further backed up by the fact that the world's largest gold-backed exchange-traded fund, that's the SPDR Gold Trust, fell to its lowest level since May 2020 yesterday. Now, an hour or so ago, Bloomberg had a bit to say on the matter as well. We'll quote them. "Stocks and bonds sold off after Federal Reserve Chair Jerome Powell underwhelmed markets by refraining from pushing back more forcefully against the recent spike in Treasury yields. The S&P 500 briefly erased its 2021 gains, notching its lowest close in about 5 weeks. Benchmark 10-year bond rates topped 1.5%, and the dollar climbed. The Nasdaq 100 extended losses from a February peak to almost 10%, and the Russell 2000 of small caps slid 2.8%. Reddit users appeared to rush back into GameStop Corp, with the video game retailer soaring. Powell said in an online event Thursday that he'd be concerned by disorderly markets, but stopped short of offering steps to curb heightened volatility. The surge in Treasury yields has triggered fears about elevated stock valuations after a torrid equity rally from the depths of the pandemic. While bulls have decided to view the jump in rates as a sign of economic strength that could lift corporate profits, there's been mounting concern over a potential inflation pickup. For Bleakley Advisory Group's Peter Bukva, the Fed has put itself in a, quote, tough situation. "We are again seeing a market that is taking control of monetary policy from the Fed," said Bukva, the firm's chief investment officer. "Long rates are rising right now because Powell is again very dovish. The more dovish they get in the face of market expectations of higher inflation, the more financial tightening we'll see," unquote. Now, despite the lingering uncertainties about the impacts of rising bond yields, such fears are misplaced, according to Candice Banksund, portfolio manager of global asset allocation at Fiera Capital. Quote, "As long as the backup in bond yields reflects stronger growth expectations versus tighter monetary policy, then the long-term bull market will not be at risk," she said. "The latest normalization in bond yields should be viewed as an encouraging sign that growth is healing, while the prospect for a hawkish turn from the Federal Reserve is clearly not in the cards today," unquote. Well, the US Senate voted to take a $1.9 trillion relief bill backed by President Joe Biden, setting off a debate expected to end this weekend with approval of the nation's 6th stimulus since the pandemic triggered lockdowns that began a year ago. Silver's fall is quite interesting in that it's getting a slight double hit here. From the monetary demand perspective, because of yields rising, it's being adversely affected there, and employment data improvements questionable at this stage. That's affecting, up until now, the rather buoyant expectations in a pickup in industrial demand for silver, therefore the double hit. Now tomorrow should prove quite revealing, and silver buyers should be getting ready to watch this space, because we have the non-farm payrolls report, and that could be quite significant. And bearing in mind, depending what the Senate does with the stimulus package, could also be significant. You see, if silver falls further, its attractiveness from an investment point of view will start to become once again quite compelling, whereas previously we felt it was slightly too high. Bearing in mind, we're still predicting much higher prices later in the year. What are your thoughts? Do share them, and if you haven't done so, please subscribe to the channel. The last few videos we've done this week, quite frankly, has been focusing more on the technicals rather than perhaps on the let's buy this new shiny piece of gold or shiny piece of silver. The reason being is that most of the factors that are currently affecting gold and silver prices are in fact what's going on primarily in the paper markets, and almost anything that's happening in the physical market is not really having much bearing on the underlying gold and silver price, except of course for premiums that people have to pay if they want the physical. We are now witnessing a further spread between the physical price and the paper price, and we suspect this may still continue for a short while yet. But if silver does fall further, remember we've put an absolute bottom of $24, saying that if it does go below that, then $20 is in theory a potential target. But for this week, we did not expect silver to fall below $25, and we shall see tomorrow if we're right. That was our outlier, I think, sort of price bracket. Let's wait and see. It'll be interesting. Anything else pales into insignificance. While yields are on the way up, the dollar strengthens, and of course we await to hear what happens to jobs data and the stimulus package. If it's not voted on tomorrow, then on the weekend. Thank you for listening. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.